This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. My guest today is Rob Arnott. He's an American entrepreneur, investor, editor, and writer who focuses on articles about quantitative investing. He also serves as chairman and chief executive officer of Research Affiliates, LLC, which advises on over $160 billion in institutional investment assets. Rob has also served as a visiting professor of finance at the UCLA Anderson School of Management, on the editorial board of the Journal of Portfolio Management, and advised the product advisory board of the Chicago Mercantile Exchange and the Chicago Board Options Exchange. I aim to have wide diversity on this show. Now, of course, as a guy involved in trading books, that's where I start. Now, anyone who listens knows that I'm willing to go in a multitude of directions on this show. But what I like is clean thinking, clear thinking, reasoned thinking. And that always brings me back to trading, to investments. I'm very fortunate today to have one of the world's preeminent voices on good investment strategy on this show. I hope you enjoy this conversation with Rob Arnott. You've got this great title that the average person still kind of thinks, what does that mean? A quant. Now a quant in the investing world, a quant in the finance world. But take me back in time. I mean, I've seen you say that this is the direction you wanted to go as a young man. Really, you had a couple directions I've seen you said you wanted to go. But take me back in time to a young man. Who were you at 16, 17, 18? What were you thinking at that point in time? Obviously, you were going down the academic path. You were getting all the right grades you needed, unlike some of us. Give me an idea of what you were like as the young guy. What were you thinking?
Well, when I was 16, I was just finishing up high school, was very mathematically inclined, avid interest in the stock market and the stars. So I was trying to decide, do I want to go into astrophysics or do I want to go into investing? I think the decision was made for me by the realization that my mathematical skills were good enough to do top-tier work in finance and not good enough to do top-tier work in astrophysics. I chose the finance path, fairly quickly was writing articles that were getting published in Journal of Portfolio Management and Financial Analyst Journal. I remember meeting Peter Bernstein when I was in my mid-20s and he was in his mid-50s. And he said, gosh, I didn't realize how young you were. And I said, gosh, I didn't realize how old you were.
What a great early mentor, though. My gosh, huh?
He was awesome. He became one of my dearest friends. When he died, I wasn't surprised, but I was shattered. I just thought it was terrible. Such a fantastic human being. I mean, there's a lot of people who accomplish wonderful things in their field. He's a Jewish guy, and in Judaism, the word mensch comes to mind. Somebody who's genuinely kind and caring human being. And that was him.
I still remember, I think it was in the 1990s, my first exposure would have been his remarkable Story of Risk book. And that was one of those eye-openers for me to get me thinking about risk in math terms. And he was all those great stories he had, just fantastic stuff.
Yeah, I mean, who could imagine writing a book called Against the Gods, which was, in effect, a history book about the history of risk and a history of our understanding of risk as it related to investment markets and having it be a bestseller. I mean, if somebody told you, I'm going to write a book about the history of risk in capital markets, do you think it'll sell well?
At that time, it wasn't like today where a really prominent person could say on social media, you must read this book. It takes off, perhaps like a Taleb book or something. It was earlier than that. So there was less of that social media push.
That's for sure. That's for sure. And actually he and I wrote, I think, 3 articles together. And the work that I did with him was, I think, the most lucid articles I ever was involved in writing. And it's because he wouldn't tolerate a lack of lucidity in the writing. It had to be absolutely accessible to the reader. If somebody with high school education wanted to read it, they should be able to read it.
That says something about when you start talking about risk, though, too. If risk measures get too complex, too complicated, they might not serve you very well either. So that clear, lucid thinking all the way down to trying to explain, you make the point.
Well, this is one of the failings of the quant community. I think the quant community has a lot of issues. Some of them relate to an addiction to complexity, and some of it relates to a willingness to obfuscate. So if you make your ideas complex enough that people can't understand it, then that creates a seductive attraction to some. But, people shouldn't buy something that they can't understand. If you've got too many moving parts, it's easier for something to break. And it's harder to know why it broke. It's harder to fix it when it does break. I like the fact that the strategies and products that we develop tend to be fairly simple. The old notion of keep it as simple as possible without losing effectiveness, or make it only as complex as necessary. Occam's razor.
Take the simplest route. If you got 2, one's complicated, one's simple, they give you the same result, go for the simple version.
Right, exactly. I mean, think back on tactical asset allocation. Generation 1 TAA simply looked at the earnings yield on stocks and the yield on treasury bonds, compared the two. And if it was 1 standard deviation higher than normal for the stocks, you buy stocks. If it was 1 standard deviation lower than normal, you tilted towards bonds. That worked brilliantly for about 20 years. Then the relationship started to break down as stocks lofted to kind of a new normal. The normal valuation since 1990 has been different from the normal valuation before the 90s. For a long time, that simple approach worked beautifully. The same thing applies to our own work on fundamental index. Fundamental index simply says, instead of weighting a company by its popularity, by its market capitalization, why don't we weight the company by how big it is, what its economic footprint is in the macroeconomy? Well, how do you measure the size of a business? You can use the size of its business by sales. What's the percentage of the macroeconomy that ExxonMobil represents, measured by sales, or measured by profits, or measured by book value, or measured by dividends, or you could use other measures like number of employees. And it turns out it doesn't matter which measure you use, any of these measures adds about 1.5% to 2% a year going back 50, 60 years. More recently, we've taken the analysis back to the 1920s, and you still get 1.5% to 2% a year, going all the way back to the 20s.
Versus just the pure market cap. I took you off on a tangent here, but I want to be like a Quentin Tarantino film for a second and kind of jump time frames. I want to keep you back before we dive into current day and dive into a lot of your current work and where you've gone. Take me back, though, for a moment. When you're at that time at meeting Peter, give me the age. When you're walking out of college, 20, 22 years old. What year are we speaking of right at that point in time?
I got out of college in 77. I took my time getting through college. I was 23 when I got out of college. Started work immediately for the Boston Company, which owned Boston Safe Deposit and Trust Bank. It was an institutional asset management company also. And it was a member of the Q Group, which I didn't realize it at the time, but it was a newly formed group that had only started, I think, in 1974, and this was 1977. And I met Peter Bernstein, I think, in 1979, so I would have been 25, at the Q Group.
What's really interesting about that time is I think to some of the other traders, fund managers that I've met in my lifetime so far, and different styles, and we can talk about that in further in the call. But that time period, the late 70s, unique in the sense, this is, and maybe even into the early 70s some, but this is a time where if you were involved in finance, you could now get your hands on coding. You could now test things. You could dig in more than you could in other generations.
Exactly. So that was the notion of being a quant was impossible in the 1950s, in the early 60s. It was unimaginably expensive in the late 60s. It was only in the 70s that it became even possible to contemplate using quantitative methods. So I was a quant before the term quant was coined. I think the term quant was probably coined right about 1979 or 80, and I was a quant right from the get-go in 1977.
Were you knowing about the Apple products like almost immediately?
I was a late adopter of Apple products. Apple, keep in mind, Apple was designing products to be beautiful, simple, and accessible to the everyman. It didn't seek out the geek crowd. The geek crowd wasn't necessarily going to be drawn to something extremely simple.
I was thinking even earlier, I guess, when they first would have launched, because, there could not have been any more of a geek than Wozniak, of course, once Jobs started. I randomly met him 2 years ago in Saigon, Vietnam airport. Is that not crazy? Steve Wozniak.
That's wild. That's wild.
Yeah,
no, the Apple One was, if I was still involved in systems programming, which is programming at the bit level, I might have found the Apple One to be just fascinating. But that's how I paid my way through college, was systems programming.
Speak to that for a moment. Let's talk about that, because you start to look at markets. You have the ability to test ideas. Today, somebody can go and they can connect up with a trade station or something and buy these beautiful off-the-shelf products. Now, all those bells and whistles would have not been necessarily, you would not have been thinking about those or not even needed those to test and explore early on. Speak to the audience and some of your early testing, because it's a very solo process. I mean, right now everybody can look at the headlines and all that kind of stuff. But when this started, this was you testing in your mind, your ideas. There wasn't a big crowd or anything. This was a very solo venture.
No, there weren't a lot of us. These days, the quant community is crowded with a lot of people who are very, very smart, very well educated, a lot of physics PhDs, that kind of thing. When I hire these hard sciences PhDs, I tend to view them as a missile that's going to go 20,000 miles an hour in some direction. And it's my job to make sure we point them in a useful direction, because they're going to go 20,000 miles an hour some direction. But to them, the numbers are just numbers and the signals are just signals. They'll mine the data however much We allow them to mine the data. The risk of data mining becomes quite severe. Back in the early days, I was doing just basically simple Fortran programming and writing programs to search through databases and assemble simple models to backtest simple ideas. For instance, if you filter stocks on price to book value, rank them based on their Z-scores. For price to book value, what's 1 point in Z-score worth in terms of return year by year and on average over time? Do the same thing with price to earnings, price to sales, and so forth. Fairly early on, found that price to sales, which was not very popular, hardly anyone looked at it, was actually more powerful than the others. So early days of my career did fairly well just by relying on a valuation metric that wasn't widely used. Found other things that were pretty powerful, volume measures, that rising volume suggested rising interest in a stock and was bullish, falling volume was bearish. Very common sense stuff, but always using scientific method, which meant don't mine the data and then try and come up with the explanation afterwards, the rationalization for why it might work the way you discover it works. Start with a premise and then test the premise. And then don't tweak the model endlessly to try to extract the best possible fit, because that best possible fit is probably not going to work nearly as well in the future as it worked in the past. If you try to improve your model historically, you may not be improving it on a forward-looking basis at all. Right from the beginning, I was very wary about data mining long before I had ever heard the words data mining.
There must have been an aha moment at some point in time. Because look, we've got this, and I've seen you say, one of your heroes, Jack Bogle of Vanguard, and, he puts in motion this indexing process that so many people adopt. But you had an aha moment at some point in time. I assume probably you were alone. This is something where you said, my gosh, this is going to be something. I want to go down this path. Maybe you didn't know how big it was going to be, but I want to go down this path. I want to go down the path of putting indexes together, not based on market cap. Even though you could look out there and see all this success at Vanguard, I mean, that's fairly daunting to say to yourself, wow, okay, these guys are killing it. I've got a new idea, a new mousetrap. How did that happen?
I've never worried about other people killing it with their products, because their products started out small and started out as a fledgling idea. I mean, I know Jack Bogle's history well. I think of him as a friend with whom I disagree strenuously on a couple of topics, one of which is fundamental index. But I have huge admiration for him, and I think of him very fondly. But when he started, the IPO for the index trust was generally viewed as an utter failure. The expectation was they were going to raise $100 to $150 million, and I think they raised $11 million. And the brokers who were involved in raising the funds at the IPO wanted to just kill it. He courageously said, absolutely not. We have the world's first index fund. So we're going to start with $11 million. So we don't even have enough to buy all 500 stocks. We'll buy as many as we can. We'll see how it goes. But he was confident that it was a good idea and worth pursuing. I've always felt that if you have an idea that you think is a good idea, give it a try. Be very patient. Be willing to stand behind it for several years. Don't throw in the towel for several years. Be willing to do the missionary work to get people interested in the idea. Sometimes the ideas take off pretty fast, like fundamental index and tactical asset allocation. Sometimes they take off really quite slow. You mustn't be troubled by the fact that others with other ideas have been massively successful and already seem to own the space that you're trying to enter. New ideas always start out with nothing. They always do.
Yeah, there'd be no Jeff Bezos, right? I mean, if he was daunted by that.
Yeah, I mean, if he was afraid of, stores have all the sales, bookstores sell all of the books. How can I possibly start a business that sells books without having a store? No, he was a glass half full guy who said, nobody's doing this. Why shouldn't I sell books across the internet and have people just connect with me on the internet, say I want this book, and we'll figure out ways to make it efficient, sell it for less than the bookstores. As he said in a recent interview, your pricing power, your ability to control the price of your product is my future entree to your business.
As authors, I don't think any of us really want to comment on Amazon, but let's just say they have all the power.
Oh, they sure do. They sure do. And when it comes to, I mean, if you're writing a novel and they're squeezing your margins, that's troublesome. If you're in our business, chances are you have various sources of income, and the book royalties are only a part of your total income. At least I hope it's only part of your total income.
Yeah. Well, yeah, there would not be much income if that was that. Hey, let me take you to the idea when you're looking at Vanguard, their successful launch, but you start to say to yourself, hey, hold on, how is the S&P weighted? I mean, speak to this thinking that you're having where this weighting, look, if Amazon ends up being 10% of the S&P, they're getting weighted that much. In hindsight, all these things seem simple and straightforward, but you had to be thinking in a different way to kind of like say, wow, okay, let's reimagine this.
Ever since the S&P 500 was launched, there have been critics saying, wait a minute, the more expensive a stock is, the bigger the weight it gets in your portfolio. That doesn't make sense at all. And when they started running money based on the S&P, my goodness, the investment managers came out of the woodworks and mounted frontal assaults saying, firstly, if the valuation doubles, your weight doubles, so you own twice as much just because the stock's twice as expensive. That makes no sense at all. That's stupid. And frankly, I would agree with that. That's stupid. These same managers were having trouble beating the index. Interesting. There are lots of problems with indexes, and one massive advantage of indexes, and that's that they cost less. Two massive advantages. They cost less, and they'll beat most active managers. And you can prove that they'll beat most active managers quite simply because the index funds track the market, which is cap weighted. If you take the index funds out of the market, what's left is the active managers. And guess what? Collectively, they own the same portfolio. So collectively, they have to have the same results, minus trading costs, minus fees, which is going to mean that collectively they perform worse. Now, it's not quite that simple because the indexes don't cover the entire stock market. There are investors who aren't professional money managers. The professional money managers aren't holding quite the same as the index, but it's pretty close to the same thing.
A key word you just said there, that was collectively, because as I've seen you say, look, you can beat the market. It's the collectively issue. It's in play.
That's exactly right. And that's where their standard argument, active managers can't beat us because of this. Well, that's not true. An active manager can win if there's some loser on the other side of the trade. Now, that loser on the other side of the trade can be another active manager, or can be one of the legions of performance-chasing individual investors, or can be an individual investor who's firing an active manager or redeeming a mutual fund just after it had a lousy 3-year run and everything in the portfolio is dirt cheap, and it's a wonderful time to buy that fund instead of liquidating it. Well, those investors are legion. So if you have a strategy that takes the other side of those trades, it's likely to work. Cool. Now, the other thing that's interesting, and by the way, I am a fan of indexing. I think indexing is the go-to strategy, the strategy you should use unless you think you've found a better idea. Relative to most active managers, it's a preferred option, especially for taxable investors, because mindless turnover, careless turnover, creates tax obligations that you will pay. You'll have a negative tax alpha on your portfolio from sloppy active management. But the index funds systematically buy high and sell low. There's a few ways you can prove this. One, stocks that are added to the index generally are trading 1.5 to 2 times the market multiple. Stocks that are dropped from the index, if it's not a corporate action, a merger, an acquisition, if it's a discretionary deletion where the stock just is eliminated from the index by the S&P committee or by the Russell formula, chances are it's a really out of favor company that's trading really cheap. So what we find is the stocks that are added on average are trading 3 times the multiple of the stocks that are dropped. 3 times the multiple. How do they perform? In the first year after they're added, the stocks that are added generally underperform by an average of 600 to 1,000 basis points, 6 to 10 percentage points. That's big. The stocks that are deleted from the index generally outperform by 8 to 1,100 basis points. That's a spread of nearly 2,000 basis points.
That's real data.
That's real data. You want to beat the index? Why don't you run an index fund where whenever the index is changed, you jot down a note on your calendar 1 year from now, and you make the change a year late? You will beat the index by that 2,000 basis points times the turnover. The turnover is about 2 to 3%, so that gives you 40 to 60 basis point advantage. That's not bad.
And I think the key there, as you describe that, that's just one example, but it's the thinking. It's the thought process, the system process, the digging in and saying, let's reimagine this. And for example, as we're already kind of going in that direction, the idea of not looking at an index only based on market caps, and you kind of say, hey, let's look at these other factors. There's other factors we can look at. Speak to that, and also speak to the, kind of bring people into your world of thinking about these other factors. And if we start to put an index together based on other factors, how do we measure those factors? Then how do we rebalance those factors? Speak to that issue. This really starts to get to the heart of your world.
Well, the idea of fundamental index had actually been in my mind going back to the mid-90s. I'd just never done anything with it. One of my dear friends in the business, a guy named George Kane, who was the founding president of the Common Fund. They manage commingled university endowments for universities with endowments that are too small to hire a big staff of their own. When he was running the Common Fund, they had a brilliant record of running a commingled trust for equities, for bonds, and so forth. It disturbed him tremendously to watch universities buy index funds, big state pension funds buy index funds, and to watch during the tech bubble as companies like Intel and Microsoft and so forth ran up to astronomical weights in the portfolio as the tech bubble was cresting. He came to me in 2001 and said, I sit on a couple of state pension boards. Notably, he sat on the New York board, which had 40% of its money indexed. And he said, I watched this happen. I watched the tech sector rise to 32% of the index and then crash. And because it became so expensive, it became a huge part of their portfolio, so that a huge part of their portfolio crashed. There's got to be a better way to do this. And I immediately thought back to my old idea of weighting the portfolio, not proportional to the popularity of a stock, not proportional to its price or its market cap, but proportional to the size of its business. So that instead of mirroring the look and composition of the market, you'd be mirroring the look and composition of the macroeconomy. Think of it as an economy-weighted index. I had long thought that a sales-weighted or a book value-weighted index would be interesting and would probably beat the market by some margin. I was just starting Research Affiliates at the time. I asked my newly minted PhD research guy, Jason Su, to track down the data to do a back test, and we were able to test it back to 1974, I think, so about 30 years of data. To our astonishment, it beat the market by 2.5% a year. I was expecting a few dozen basis points, not hundreds.
That's using your internally developed factors outside of market cap.
Right. Don't think of it as factors, because the factor tilt world is different. This isn't really a factor tilt. It's weighting a company according to the size of the business. It's not
the economic business, where it fits into the broad economy.
Correct. Now it has factor tilts. That is to say, it always has a value tilt. It sometimes has a size tilt and so forth. But it's not like the factor tilt strategies that are becoming very popular these days. It's very different from that. It completely severs the link between the price of a stock and its weight in the portfolio. And that's the beauty of it. That's why it works, because it no longer systematically and automatically overweights the overvalued companies and underweights the undervalued, which is the Achilles heel of cap weighting. So one of the aha moments was when we tested all sorts of different weighting schemes, and they all added about the same value. And I wondered, what's going on here? They're all roughly the same. The one that's not is cap weight, which is 2% behind any of them. And I suddenly realized, it doesn't work because of the fundamentals. It works because it breaks the link with price. And so we tested minimum variance, we tested equal weight, a variety of other strategies that also break the link with price. And they also added about 2%. So no matter what you do, if you break the link with price, you're going to add 1.5% to 2% a year. We partnered with Nomura to make it available in Japan. They had deep databases, which we didn't at the time. We do now, of course. They tested it all over the world, and they found that it worked in 23 out of 24 countries around the world. Going back 30 years, we were now able to take it back 40 years in the U.S., and it worked on average about the same all over the world. Country by country, it varied, but the average was 2 to 2.5% outside the U.S. Well, that's pretty cool.
As a quant guy, and you're digging in at this stage of development of the firm, and you speak to the issue right there, you say, okay, breaking the link with price. Well, that gives the audience a perspective, an investment perspective. Your style, your thinking is more value-based, clearly. Speak to, though, breaking the link with price, because that kind of hints at like, hey, let's steer clear of the momentum or the trend chasing strategies. But a guy like you that's testing everything under the sun, you're seeing some viability in those strategies. Or give me some perspective at this point in time, because this is one of these great yin and yangs, or this is how I would see it. You might see it completely differently, but you do always see you got value on one side, you got momentum on the other side. This is something that still is confusing for people.
Well, momentum's very popular. There's a lot of momentum strategies out there, both formal momentum strategies that deliberately seek momentum, and accidental momentum strategies when people just buy something because it's gone up and they're enthusiastic about it. I think there's way more money managed with accidental momentum than with deliberate momentum, because who wants to buy something that's gone way down? It goes against human nature. Anything that's given us joy and profit, we want more of. Anything that's given us pain and losses, it's get me out of here. And that's deeply ingrained in human nature. Momentum has been tested endlessly. The first major study of momentum in stocks was by two professors, Jagadish and Titman, that was published in 1993. What's interesting to me is momentum worked as a strategy beautifully as far back as you can get data until 1999. Then, when the tech bubble burst, you had your first momentum crash. The stocks with the terrific momentum, the tech stocks crashed. You crashed and burned with a momentum strategy then. You had another worse momentum crash in 2009, and some smaller momentum crashes, both between those two big ones and one smaller one after 2009. The result is that standard momentum, if you go back to 1999 and you were running a standard momentum strategy from 1999 to date, and if you were able to trade for free, you would have made no money.
Let me let you add something there, though, too, because just so we can keep the audience going with this thinking. When you're speaking of momentum, there's probably more than the two types that I'm about to say, but we can think of, at least for me, I'm thinking, okay, you got time series over here, you got cross-sectional over here. Then there's also the idea of what type of portfolio are you trading? So why don't you clarify a little there on your thinking?
Standard momentum is basically favoring the stocks that have the best performance over the last year. Technically, standard momentum excludes the most recent month. So it's trailing 1 year, excluding the latest month, and then avoiding the stocks with the worst performance over the last year, excluding the latest month. So that's standard momentum. There are at least hundreds of ways to define momentum. They all rhyme. They all behave somewhat similarly. The fact that standard momentum had its first peak in 1999, another peak in 2002, another peak in 2007, and then after the 2009 crash, you've been struggling your way back since then, and you still, to this day, are below the 1999 peak. That means for 18 years, you haven't made money with momentum. That's the dirty secret of the momentum business. So it works most of the time, but when it crashes so hard that you better not be using it when it crashes. So that is the big problem with momentum.
As you say that, Rob, what type of markets are you thinking of? Are you strictly in the equity world as you're saying that?
This is mostly the equity world. To a lesser extent, it happens elsewhere. You can see it in the commodities world. To a much lesser extent, you can see it in currencies and bonds, but mostly it's the equity world. So momentum is, you better know what you're doing in momentum if you're going to use it. But the premise behind your question, the yin and yang, momentum buys what's performed well, value buys what's performed badly. So they are complementary. When momentum is working, you really want momentum and value as a pair of strategies. The combination is powerful. When momentum is not working, you better not be using it. Value also goes through cycles. Value, just as one example, value peaked in 2007, and it's had a horrible decade. Growth has beat value by 350 basis points per year compounded for the last 10 years. Oh my goodness. That's almost as bad as value's performance at the peak of the tech bubble in February of 2000. It's unbelievably bad. Does that mean value has changed and is permanently impaired and should be avoided? Or does it mean that value is now trading at bargain basement prices and is a bargain that deserves to get all of our investment dollars? I think it's a bargain in the U.S., but I think it's a screaming bargain outside the U.S., especially in emerging markets. So the short answer to that question is watch the valuation. Some of these strategies are trading rich and should be avoided. Some of these strategies are trading cheap and deserve outsized attention. So one of the things that we've been investing a lot of our time and research on is how to gauge when strategies are likely to work and when they're not likely to work. And it turns out relative valuation is a very powerful tool, even for momentum. Whenever momentum is saying, as it is right now, chase the bubbly tech stocks, chase whatever is unbelievably hot, that's when you're better off saying, no thank you, I better not use momentum right now. Because that's when you're likely to have a momentum crash.
Let me take it back here also to the idea of when you start to assemble your first fundamental indexes, because you're kind of hinting at this in the last few minutes, which is how does one know that something has become expensive or is not expensive? So for example, you say, hey, let's move away from market cap as one of the weightings. Let's go to these other weightings that we start to develop. Okay, once you go to those weightings though, the world's not static. It's, things change. Speak to how you decide those weighting changes, because, when something's more expensive or not expensive. And I'm also be curious, I'm assuming this is something that is automated. This is not necessarily not discretionary. This is all systematic.
It absolutely is. Back in February, we launched a website called Smart Beta Interactive. If you Google Smart Beta Interactive and scroll past the ads of those who piggyback on our website, but with paid promotions, the first thing that pops up that's not an ad is our website, which is an interactive website for looking at smart beta strategies and factors. And what that website does is it poses a very simple question. Yes, it will help answer the question, how has this strategy or factor performed in the past? But much more important than that, it asks the question, how can this strategy perform in the future? How is it likely to perform in the future? And it bases that analysis on how expensive is the strategy today relative to its own historical norms. Value is always cheap by definition. That's the definition of value. It's stocks that are trading cheap. But sometimes value stocks are trading at a little discount to the market, and sometimes they're trading at a big discount to the market. When value is trading at a big discount to the market, you don't want to just load up on value. You want to take a deep value tilt in your portfolio. You want to look for the deepest value managers you can find. That's when you want to load up on LSV's products, for instance. If value is trading rich relative to history, then maybe you don't want to pay that much attention to the value strategies that are out there. When we invented fundamental index back in 2004, we did not think to look at relative valuation. So fundamental index worked very nicely in 2005 and 2006 and early 2007, and we were pleased. And we noticed that fundamental index was making smaller and smaller and smaller bets. So our tracking error relative to the market was getting tighter and tighter. We were looking more and more like the market. Well, fundamental index takes the growth stocks down from their market weight to their economic weight, and the value stocks up from their depressed market weight to their larger economic weight. When the market's paying a skinny premium for growth, the shift in our weight for growth, we downweight the growth stocks only a little bit and upweight the value stocks only a little bit. We have a small value tilt. When the market's paying a huge premium for growth, we take on a huge value tilt. What was happening, and we didn't even fully understand it at the time.
This is coming into 2007.
Yeah, okay. Was that our bet on value was getting smaller and smaller. So when the quant crash happened in August of 2007, there were some strategies that lost literally thousands of basis points of performance in 3 days in August of 2007. That's why it's called the quant crash. Our strategy underperformed by 1% in those 3 days. Now, we thought 1% underperformance in 3 days. Oh my goodness, that's a big drop. But it wasn't compared to what was happening to most of the quant community, which was getting savage. If we had done this work on relative valuation at the time, we would have seen value's expensive. Avoid value. Small cap is expensive. Avoid small cap. Momentum is expensive. Avoid momentum. What did the quant community have? It had long, short strategies loading up on value, small cap, and momentum, and then leveraging those positions. And if you're taking all three of those bets and then leveraging them, no wonder you can lose 40% in 3 days. In effect, this work would at that time have suggested some pretty dire risk and would have suggested even fundamental index had a little too much value exposure, as skinny as our value exposure was. And even fundamental index was likely to get whacked a little bit. It's interesting work because it even helps us understand when our own strategies are likely to be disappointing.
Obviously, it's a very competitive landscape, but there's interesting debates and different viewpoints out there. And I think one of the viewpoints that I would love for you to kind of address it is that some folks will say, hey, trying to time these factors can be very difficult. And we think that's just not really doable. Whereas we think we should be more in a diversification mindset versus a timing mindset. Speak to this debate, because this is something, look, we can all hit the Google and we can see this rather high-end, complicated conversation from very smart people. For the investing public out there, it could get a little deep, can it?
The simple fact is everybody's timing factors. We're all timing factors. Every time we make a decision to adopt a new strategy, we're timing a factor. If you embrace a strategy that's a multi-factor, equally weighted strategy, you're timing factors because you're moving from one strategy, maybe it's a value strategy, into that multi-factor strategy. Well, that's a big move away from value. You've just made a timing bet that value is going to do badly. When you choose the factors that go into the multi-factor strategy, right now, low volatility strategies are trading rich relative to history, just like value was 10 years ago. Value has had a horrible 10 years. What if low vol has a horrible 10 years? Are these multi-factor strategies going to drop their low vol component? I bet they will. And if they drop their low vol component, are they going to be guilty of factor timing? Of course they are. I think the mere fact of which factors are chosen for the multi-factor is itself a factor timing choice. My first point is everybody does factor timing whether they realize it or not. If they say, we believe in diversification, we're not going to do factor timing, sorry, but in the design of your product, you just did factor timing in designing the product. Second thing is pretty much everyone I talk to, including the advocates of multi-factor static weights, agrees that if a strategy is trading in the top decile of historical valuations, you're not going to go far wrong to say, why don't I chop the weight on that factor in half? And if you take a strategy that's trading in the bottom decile of historical valuations, really cheap, why don't you say, let me boost my allocation on that factor by 50%. At AQR, they call that sinning a little. If that's okay to do that, then all we're really arguing about is how much sinning a little is, what threshold of sinning is okay and what threshold of sinning isn't okay. So I would say everybody does factor timing. The only question is, how much factor timing do you want to do in your investments? And what do you want to base that factor timing on? Do you want to base it on, hey, what's performed best in the past? That's what most people do. Or do you want to base it on, hey, what's trading cheapest now relative to its own historical norms? What strategy is priced today to be likely to perform better than in the past? I'd sure rather do the latter than to follow the lemmings by doing the former.
Very clear perspective. I want to shift you to something, though, that you mentioned earlier. You used the word tactical earlier in our conversation. And I would love to throw a name out there for you. He's one of my favorite guests on this podcast, one of my favorite people. I've met him, I think, at least twice, I believe. Harry Markowitz.
Oh, he's one of my favorite people, too. Another guy who I would cheerfully attach the word mensch to.
I mean, one of the nicest guys ever. I mean, really.
He turns 90 in exactly 1 month from today.
I got to get him back on the show then for sure. I talked, it was 2 or 3 years ago when I had him on this show, and it was so great. And I interviewed him in person before. I called him up for the podcast, and he answers the phone, and it's like, "This is Harry Markowitz. How are you?" You're just like, "Hold on. How old are you, Harry?" It's like, he's like the youngest 90-year-old guy ever, huh?
He is. He's a breath of fresh air in his optimism, in his cheeriness, in his enthusiasm, in his curiosity. And the curiosity extends way beyond investments and the mathematics of finance. I mean, he wrote a paper about how he thinks ants find food in a house. All right.
If he gets back to his early career, he was kind of always a bit of an outsider. He was not like, he kind of did this paper, and I think most of the people in Chicago were like, hold on, where did this come from? Obviously they knew who he was, but still he was kind of an outsider.
Well, it was 1952, which, doing the math, means that he was 24 years old when he wrote it. So he was a young pup. I'm guessing a lot of the professors looking at this thought, this is pretty interesting, pretty powerful stuff, or pretty intelligent stuff, but how are you going to use it? Little did they know that it was going to shape an industry. He and I joke from time to time about, gosh, Harry, you should have gotten a patent. You should be collecting royalties. And he laughs. He would be 10 times richer than Bill Gates if he.
Oh wow! Yeah. Let's speak to because we start to talk about tactical as I start to think about Harry, and the basic way of thinking has always been, okay, you first we started with, hey, here's your all stock portfolio, then you added bonds, you start to look at correlations, you see, hey, we can get a little extra return, we can drop the risk a little, but speak to this idea of tactical now. It goes beyond stocks and bonds. Why don't you, because you just hinted at. Not hinted, but you mentioned the worldwide opportunities. But speak to the idea of tactical right now.
Yeah, we're actually doing a paper right now, should come out in a few months, challenging the notion of benchmarks. The working title is Hobbled by Benchmarks. When we create a benchmark for our portfolio, we automatically anchor to it and are drawn towards it. And so if 60-40 is your benchmark, you're going to hold a portfolio that looks an awful lot like 60-40. You just will. You're going to miss out on a whole lot of diversification opportunities. The diversifiers have the effect of, one, allowing you to reduce risk, while two, allowing you to pursue diversifying risk premia and thereby earning a higher return. Well, that's cool. There's also an excess return associated with diversification in and of itself. If you take stocks and you earn 10% on them, and you take bonds and you earn 10% on them, a 50-50 portfolio won't earn 10%. It'll earn more than 10% because there's a premium picked up as a consequence of diversification. Well, that premium goes up almost linearly with the number of diversifiers you use in the portfolio. So if you have 10 diversifying asset classes, all lightly correlated, you get almost 10 times the advantage that you get with having one. That's really cool. When we assign ourselves a benchmark that's heavily anchored on just two asset classes, one core asset class and one for diversification, we hobble ourselves and reduce our opportunity set. It's fun when you think about the opportunity to add value with broader diversification. The opportunity is huge, especially right now. Why especially right now? Because U.S. bonds are priced to give you 0.5% real. Yield is 2.5%. Inflation expectations are 2%. The difference is 0.5%. That's your real return. And stocks are priced to give you about 0.5% real. That sounds unbelievably bleak, but the arithmetic is compelling. The yield is 2%. Over the last 100 years, earnings and dividends have grown 1% faster than inflation, actually 1.25%. If growth in the future is as fast as it was over the last remarkable century, then 1.25% real growth in earnings and dividends plus 2% from yield gives you 3.25% real return. That's not bad, but that's what you'll earn if the Shiller PE ratio is still 31 times earnings, which it is right now. Still 31 times earnings 10 years from now.
To add to your thinking here on the diversifiers, adding in the non-correlated diversifiers, in my world, I've done some work on the managed futures side of things, the time series momentum. Now it's not value, it's not stocks only, it's diversified over a lot of different asset classes. But as a math guy, I know you appreciate when you can take that stream and generally add it in to the typical stock and bond portfolio and get some risk reduction, get some enhanced return. Why do you think after all these decades, and maybe you're going to correct me and say, Mike, I disagree, but why do you think after all these decades, we still don't see something like that style of momentum being used more by advisors? Why is there seemingly a discounting, or I don't want to touch that hot potato?
I think there's two reasons for it. One, people see and are spooked by the momentum crashes. And two, the benefits of diversification are modest and are earned over long periods of time. The issue of career risk comes into play. We talk about these portfolios having a time horizon that is long. Typical pension has a 50 to 75 year tail on it of benefits that are going to be paid out decades in the future. But the people responsible for overseeing the pension, board members, have an average time on the investment committee of about 3 years. Executives involved in overseeing a pension have an average time in their position of 5 to 6 years. That means the whole focus is, I don't want horrible things to happen on my watch. Secondary goal, I'd like to do as well as I can on my watch, subject to no catastrophes.
You are right there in the catbird seat of seeing how modern finance, modern investing works. And for you to say that, if people are truly grasping what you just said, it's kind of sad about our current investing climate, at least for some of those that are the caretakers of great size and assets. It's not the most fun thing to hear someone who knows how things work say that.
There's two ways to look at it. Again, glass half full, glass half empty. Your ordinary retail investor usually has a time horizon a lot shorter than that and is a ferocious performance chaser. Hear about an investment at a cocktail party, invest in it the next day. A year later, it's been really disappointing, bail out. And almost never think in a contrarian fashion, gee, this has gone down. I wonder, is it cheap enough to buy more? Or, gee, this has doubled. I wonder if I should take my winnings and take my chips off the table. No, the thinking is the opposite. This thing has soared. I want more of that. Or this thing has soared and I haven't been invested in it. I better get in. This other thing is a turkey that's lost me money. Get me out of here. That's the retail thinking. And so the institutional investor, who is deeply concerned about career risk, doesn't want blow-ups, but that in turn means that they're still going to have a steady hand at the tiller. Yeah, they're going to anchor on benchmark, and yeah, the benchmark right now is priced to give them a horrible rate of return, but it's still going to be better than the retail investor. I think from a glass half full perspective, there's a lot to be said for professional asset managers from that perspective. Financial advisors. I have a very provocative view on financial advisors. I think financial advisors do their clients a fantastic service if they add no value whatsoever. Why do I say that? Because it's so easy for their clients to add hundreds of basis points of negative value add, to piss away large swaths of their wealth with really dumb decisions. And if the financial advisor merely serves as a steadying hand to make sure the client doesn't bail out at the bottom of a bear market, doesn't chase the top of a bull market, and maintains a steady course, the measured value added of the financial advisor will be zero. The value add relative to what would have happened without the financial advisor's assistance will be hundreds of basis points per annum.
One of the best ways to make money, not lose money.
Exactly. And we're in a business where you win by making fewer errors.
Rob, you've been very kind to me today. You went over time. I've got 4 pages of notes here. I could keep asking notes. You mentioned performance chasing. I would love to speak to you about that, maybe at a future call, and actually get some of your views on some of the behavioral work that's so common in finance these days. But listen, I really appreciate your time today. Great stuff. I think people are really going to enjoy this. We didn't even get a chance to talk about Liberty, which is, I know, a big, near and dear thought to you as well. The best place for people to go check you out, research affiliates. There are papers across the internet. There are articles people can dig in for a lot more information. Anything else place you want to send people beyond the company website?
Our interactive tools for asset allocation and for looking at smart beta are well worth a look. They've both gone viral. The asset allocation interactive and smart beta interactive, if you Google just those words, asset allocation interactive or smart beta interactive, and click the first link that says research affiliates, it'll take you straight to those websites. The goal of both websites is to help wean people off of the temptation to put more money into whatever has performed well in the past, and to help people have the courage to put money into what's cheap and priced to offer better future performance. If we can help people do that, both websites are free. The asset allocation one has had upwards of 1 million unique hits since we launched it almost 4 years ago. And the smart beta ones had 300,000 hits in the 7 months since we launched that. So these have gone viral. They're well worth a look. I would encourage folks to take a look, see what you think, and you might find them to be useful tools in thinking about how you invest.
Rob, once again, I appreciate your time today. Thank you very much.
Thank you. This has been fun.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.